You probably know someone with a 150 IQ who's always struggling with money, while someone with average intelligence built a fortune. Charlie Munger spent 50 years studying this paradox, and what he discovered about incentive-caused bias explains why intelligence and wealth rarely correlate. Here's the mental trap that keeps even brilliant people broke. 1994, University of Southern California Law School. Charlie Munger is 70 years old, standing at a podium delivering a commencement speech. He's about to explain something that will fundamentally change how these graduates think about success. He starts with a question. Why do brilliant people make terrible decisions? Think about it. Wall Street is filled with people who graduated top of their class from Harvard, MIT, Wharton, genius-level IQs, access to every resource imaginable. And yet, study after study shows they consistently underperform the market. Charlie looks out at the audience. I've watched this for decades, he says. I've seen PhDs in physics blow up hedge funds. I've watched brilliant lawyers give catastrophic advice. I've observed genius-level investors lose everything on obviously bad bets. The audience leans in, because here's what nobody wants to admit. Intelligence doesn't protect you from stupidity. In fact, in Charlie's framework, high intelligence can actually make you more vulnerable to certain kinds of catastrophic mistakes. He pauses. Never ever think about something else when you should be thinking about the power of incentives. That sentence, that one sentence, it's the key to understanding why your brilliant friend who can solve complex equations can't seem to build wealth, why your genius coworker with perfect SAT scores is drowning in debt. Why someone with average intelligence who understands incentive-caused bias can systematically build a fortune. Charlie spent 70 years studying this. Today, we're breaking down exactly what he discovered. I'm Michael, and this is The Wisdom Investor, where we break down Charlie Munger's most powerful insights into how the world actually works. So let's get straight into this, because what I'm about to share with you completely changed how I think about intelligence, wealth, and decision-making. Here's the thing that most people get wrong. We've been conditioned to believe that smart people make more money. Higher IQ equals higher income, right? Get straight A's, go to a top university, land a prestigious job, and wealth follows naturally. Except that's not what the data shows, and Charlie Munger spent decades figuring out why. Let me take you back to 1994. Charlie's delivering this commencement speech at USC Law School, and he's talking to a room full of people who just graduated from one of the top law schools in the country. These are objectively brilliant people, top test scores, incredible work ethic. They've proven they can master complex material. And Charlie looks at them and essentially says, everything you've learned about how to succeed is incomplete, because you haven't learned about the psychological forces that will sabotage your decision-making for the rest of your life. He called it the psychology of human misjudgment, and at the center of this framework is one of the most powerful concepts he ever identified: incentive-caused bias. Now, here's what actually happened that made Charlie obsessed with this idea. Let me take you back even further, 1960s and 70s. Charlie's running his investment partnership, Wheeler, Munger and Company. He's analyzing companies, meeting with management teams, watching how businesses operate. And he keeps seeing the same pattern over and over again. Smart people, brilliant people, people with impeccable credentials making absolutely catastrophic decisions, not because they're stupid, but because their incentives are misaligned with reality. Let me give you a concrete example that Charlie loved to use. Think about a commissioned salesperson, someone selling financial products. This person might have an MBA from Stanford, genius-level intelligence. They understand the products they're selling better than almost anyone. But here's the trap: they get paid a commission every time they sell a product. The bigger the commission, the more they make. Their mortgage payment depends on closing deals. Their kids' college fund grows when they hit quota. Their entire lifestyle is built around maximizing sales. Now you come to them asking for financial advice. What do you think happens? Even if this person is fundamentally honest, even if they genuinely want to help you, their brain has been hijacked by the incentive structure. They will genuinely believe that the highest commission product is the best option for you, not because they're lying, but because incentive-caused bias has literally changed how they process information. Charlie said it perfectly: never ever think about something else when you should be thinking about the power of incentives. Think about how insane that is for a second. You can be brilliant, you can have perfect information, you can genuinely want to make the right choice, and your brain will still distort reality to align with your incentives. This is why smart people stay poor, not because they lack intelligence, but because they don't understand or account for incentive-caused bias in their decision-making. Let me show you how this plays out in real life. I spent weeks researching this, and the patterns are absolutely everywhere once you know what to look for. Example 1, the brilliant corporate executive. Let's say you're a CEO. You went to Harvard Business School. You have an IQ of 140. You're objectively one of the smartest people in any room. But your compensation is structured like this. Base salary of $500,000. Stock options worth $10 million that vest if the stock price hits certain targets. Quarterly bonuses tied to revenue growth. What happens to your decision-making? Even if you're a good person, even if you care about the company's long-term health, your brain starts optimizing for what gets you paid. You start making decisions that boost short-term stock prices even if they damage long-term fundamentals. You start pursuing revenue growth even if it means taking on unsustainable debt, not because you're evil, but because incentive-caused bias has reprogrammed how you think about what's good for the company. Charlie watched this happen at thousands of companies. Smart CEOs destroying shareholder value while getting personally rich. And here's the crazy part. Most of them genuinely believed they were making good decisions for the company. The incentive structure had literally changed their perception of reality. Example 2, the financial advisor trap. This is one Charlie talked about constantly. You go to a financial advisor for help. This person might be incredibly intelligent. CFA charter holder, decades of experience, genuinely wants to help clients. But they work for a firm that pays them based on assets under management. The more money you give them to manage, the more they make. And their firm has relationships with certain mutual fund companies that pay referral fees. What happens? Even with the best intentions, their advice will be skewed towards solutions that maximize their compensation. They'll recommend actively managed funds over low-cost index funds, because actively managed funds generate higher fees. They'll encourage you to consolidate all your assets with their firm, even if spreading across multiple institutions might be smarter. They'll talk you out of paying off your mortgage early, because that money would be better invested where they can manage it and collect fees. They're not lying. They genuinely believe this advice is in your best interest, because incentive-caused bias has made them incapable of seeing the conflict of interest clearly. Now here's where this gets really interesting. Charlie didn't just identify this problem, he built an entire systematic approach to dealing with it. And this is the part that separates brilliant people who stay poor from brilliant people who build wealth. The key insight is this: you can't eliminate incentive-caused bias. It's hardwired into human psychology, but you can build systems that account for it. Charlie's approach had 3 core elements. First, always ask what the incentives are. Second, assume the incentives will distort judgment even in smart, honest people. Third, design systems where incentives align with desired outcomes. Let me show you how he applied this in his own life and investing career. When Charlie was analyzing a company, he didn't just look at the numbers. He looked at management compensation structures. How are the executives paid? What behaviors does their compensation incentivize? Are their incentives aligned with long-term shareholder value, or are they optimized for short-term stock price manipulation? If he saw compensation structures that rewarded short-term thinking, he passed on the investment. Didn't matter how smart the management team was. Didn't matter how good the business model looked on paper. If the incentives were wrong, the outcomes would eventually be wrong too. Here's a specific example. Back in the 1990s, Charlie and Warren were looking at a company with brilliant management. I mean, absolutely top-tier executives. The business fundamentals looked solid. The competitive position was strong. But the compensation structure was a disaster. The CEO had massive stock options that vested if the stock hit certain targets by specific dates. What does that incentivize? Aggressive accounting, short-term revenue pumping, maybe even fraudulent behavior to hit those targets before the deadlines. Charlie and Warren passed. The company later collapsed in an accounting scandal. The CEO went to prison. Smart guy, great education. Destroyed his life and thousands of shareholders because the incentive structure made fraudulent behavior seem rational in the moment. Now let's bring this back to you. Why do smart people stay poor? Let me walk through the most common traps I see. Trap 1. The high-income professional who never builds wealth. This is someone making $200,000, $300,000, maybe $500,000 a year. Doctor, lawyer, consultant, whatever. Brilliant person, top of their field. But they're broke, always stressed about money, no meaningful savings, drowning in debt. What's happening? The incentive structure of their social circle has hijacked their decision-making. All their colleagues have big houses in expensive neighborhoods. Everyone drives luxury cars. There's an unspoken competition about vacation destinations and private school tuition. So even though they're intellectually brilliant, even though they understand compound interest and investment returns, they spend every dollar they make trying to signal status to their peer group. The social incentive to appear successful has overridden their intellectual understanding that this behavior is destroying their financial future. They genuinely believe they need the big house and the luxury car to maintain their professional credibility. Incentive-caused bias has made it impossible for them to see that they're on a treadmill that will never lead to actual wealth. Trap 2. The brilliant employee who never becomes an owner. This is someone with a high IQ working for a company. They're incredibly valuable. They solve complex problems. The company couldn't function without them. But they're getting paid a salary while the owners build equity. And here's the trap. The company has designed an incentive structure to keep them as an employee forever. Annual bonuses, stock options that vest over time, a comfortable salary that makes the risk of entrepreneurship seem unnecessary. So this brilliant person spends 30 years making other people wealthy because the incentive structure has made staying an employee feel like the smart choice. They never build significant equity. They never develop ownership-level wealth, not because they're not smart enough, but because the incentive structure kept them comfortable enough to never take the risk of building something themselves. Trap 3. The smart investor who follows terrible advice. This is someone who understands investing intellectually. They read books. They understand compound returns. They know the basics of valuation. But they keep listening to financial media, following hot stock tips, trading frequently, chasing performance. Why? Because the entire financial media industry has incentive structures designed to keep you trading. CNBC needs you to believe the market is exciting and that you need to act daily. Stock analysts need to publish new recommendations constantly to justify their existence. Investment newsletters need to create urgency so you keep subscribing. And even though this brilliant person intellectually knows that low-cost index funds held long-term beat almost all active strategies, the incentive-caused bias from the entire financial industry has convinced them that they need to be actively trading to be a sophisticated investor. Now here's what Charlie did differently, and this is the systematic approach that let him build a $2.6 billion fortune while avoiding these traps. Step 1. He made incentive analysis a core part of every decision. Before making any financial decision, he asked, what are the incentives of the person giving me this advice? How might those incentives distort their judgment? Financial advisor recommending a product, what's their commission? Analyst recommending a stock, what investment banking relationships does their firm have with that company? Friends suggesting a business opportunity, what's in it for them? Not assuming everyone is lying or dishonest, but systematically accounting for how incentives shape perception. Step 2. He designed his own incentive structures carefully. Charlie and Warren built Berkshire Hathaway with compensation structures that aligned with long-term value creation. They paid themselves relatively modest salaries. Their wealth was tied to long-term stock performance, not short-term hits. This is absolutely critical. If you want to build wealth, you need to design incentive structures in your own life that reward the behaviors that actually create wealth, not the behaviors that feel good in the moment or impress other people. Step 3. He avoided situations where incentives were fundamentally misaligned. If he couldn't fix the incentive structure, he walked away. Didn't matter how good the opportunity looked otherwise. If the incentives would inevitably lead to bad outcomes, he wasn't interested. This is the part most people miss. You can be incredibly smart and still make terrible decisions if you're operating in an environment with corrupted incentives. The smart move is not to try to outsmart the bad incentives. The smart move is to avoid those environments entirely. Let me give you some concrete examples of how to apply this in your own life right now. If you're working with a financial advisor, ask them directly, how do you get paid? What products generate the highest commissions for you? Do you have any conflicts of interest I should know about? Most people never ask these questions because they don't want to seem distrustful. But Charlie would tell you that's exactly backwards. Understanding incentives isn't about distrust, it's about clear thinking. If you're considering a job offer, don't just look at the salary. Look at the entire incentive structure. How are bonuses calculated? What behaviors get rewarded? What does the promotion structure incentivize? If the incentives reward short-term thinking or unhealthy behaviors, it doesn't matter how much they're paying you. You're walking into an environment that will distort your decision-making. If you're investing, be brutally honest about the incentive structures shaping your sources of information. That investing newsletter making you feel urgency, they need you to keep subscribing, so they're incentivized to create artificial urgency. That financial news channel making everything seem dramatic, they need you to keep watching, so they're incentivized to make markets seem more volatile and exciting than they actually are. Here's what Charlie would do. He'd read annual reports, source documents, primary information where the incentive structures are transparent. He'd avoid intermediaries whose incentives might distort the information. Now, let me show you the deeper psychological layer that makes this even more powerful. Charlie identified 25 different psychological tendencies in his Psychology of Human Misjudgment framework. Incentive-caused bias is just one of them, but it's the most powerful one because it amplifies all the others. Think about confirmation bias. You tend to notice information that confirms what you already believe and ignore information that contradicts it. Now add incentive-caused bias on top of that. If you're financially incentivized to believe something, your confirmation bias goes into overdrive. You'll actively seek out information that justifies the financially beneficial belief and completely miss information that contradicts it. Social proof, you tend to do what other people around you are doing. Add incentive-caused bias. If everyone in your social circle has incentives to spend money on status signaling, the social proof and the financial incentives create what Charlie called a Lollapalooza effect. Multiple psychological tendencies reinforcing each other, making it nearly impossible to think clearly. This is why smart people stay poor, not because they lack intelligence, but because they're operating in environments where multiple psychological biases, amplified by incentive structures, have made rational decision-making nearly impossible. Charlie's solution was systematic. Build a latticework of mental models. Understand these psychological tendencies intellectually. Then design your life, your career, your investments around systems where the incentives actually align with your long-term goals. Let me give you one more example that really crystallizes this. See's Candies, 1972. Charlie and Warren bought this company for $25 million. By traditional Benjamin Graham value investing standards, they overpaid. It wasn't a bargain based on asset values. But Charlie had analyzed the incentive structures within the company. The management team had been there for decades. They were compensated based on maintaining quality and building long-term brand value, not on short-term profit maximization. Their incentives were aligned with what actually made the business valuable. That investment generated over $2 billion in profit over the next 50 years. Why? Because the incentive structures within the company meant management would protect the brand, maintain quality, and build sustainable value rather than cutting corners for short-term gains. That's the power of understanding incentive-caused bias. Charlie didn't just avoid bad incentive structures. He actively sought out situations where incentives were aligned with long-term value creation. Now, here's the part that's uncomfortable but absolutely essential. You need to audit your own incentive structures. What are you actually incentivized to do in your career, in your investments, in your financial decisions? Are you incentivized to build long-term wealth, or are you incentivized to appear wealthy? Are you incentivized to make good decisions, or are you incentivized to make decisions that feel good to your peer group? Are you incentivized to learn and grow, or are you incentivized to protect your ego? Most people never ask these questions, and that's exactly why smart people stay poor. They have all the intelligence necessary to build wealth, but their incentive structures are pushing them in the opposite direction, and they can't see it because incentive-caused bias has made those misaligned incentives invisible to them. Charlie's famous quote is, "Show me the incentive and I'll show you the outcome." That's not cynicism, that's realism. Human beings respond to incentives. It's not a moral failing, it's a psychological reality. The question is, are you going to pretend incentives don't matter and wonder why you can't build wealth despite being smart? Or are you going to systematically analyze incentive structures and design your life around situations where your incentives align with your actual goals? Let me tell you what happened when I started applying this framework to my own life. I realized I was surrounded by incentive structures that were destroying my financial decision-making without me even realizing it. I was working with a financial advisor who was incentivized to keep me trading, not to help me build wealth. I was in a social circle where everyone was incentivized to spend money signaling status, not building equity. I was consuming financial media designed to create urgency and fear, not to help me think clearly. Once I saw those incentive structures clearly, I could make different choices. I fired the financial advisor and moved to low-cost index funds. I changed social circles. I stopped consuming financial media and started reading annual reports, not because I'm smarter than other people, but because I designed an environment where my incentives aligned with actually building wealth. That's the power of understanding incentive-caused bias. It's not about being smarter, it's about being systematic. Here's Charlie's ultimate insight on this. The first rule of a happy life is low expectations. If you understand that humans, including you, are fundamentally driven by incentives and psychological biases, you stop expecting people to act against their incentives. You stop expecting yourself to make perfect decisions in environments with corrupted incentives. Instead, you do what Charlie did. You build systems, you design incentive structures, you create environments where the right decisions are also the incentivized decisions. That's how someone with average intelligence but systematic thinking can build more wealth than someone with genius-level IQ operating in an environment with terrible incentive structures. So here's what I want you to take away from this. Intelligence is not the limiting factor in building wealth. The limiting factor is whether you understand and account for incentive-caused bias in your decision-making. Smart people stay poor because they trust their intelligence to override psychological biases and incentive structures. It doesn't work. Charlie spent 70 years watching brilliant people make catastrophic decisions because they didn't understand this. The path forward is simple but not easy. First, study incentive-caused bias until you see it everywhere. Read the Psychology of Human Misjudgment section in Poor Charlie's Almanack. Watch for it in your own life. Notice how incentives shape your own thinking. Second, systematically analyze the incentive structures in every important decision. Who's giving you advice? How do they get paid? What are they incentivized to tell you? Not from paranoia, but from intellectual honesty. Third, design your life around situations where incentives align with your actual goals. Choose advisors whose compensation structure rewards your success, not transaction volume. Build a career where your long-term wealth comes from equity, not just salary. Invest in businesses where management incentives align with shareholder value. That's the framework. That's how Charlie built a $2.6 billion fortune while watching countless brilliant people stay broke, not because he was smarter, but because he understood incentive-caused bias and built systems to account for it. Now I want to hear from you. When you look at your own financial decisions, what incentive structures have been shaping your choices without you realizing it? What misaligned incentives have been holding you back? Drop a comment below and let's discuss. If you found this valuable, hit that like button and share this episode with someone who needs to understand how incentives shape decision-making. It really helps us reach more people who can benefit from Charlie's wisdom. We release new Charlie Munger episodes every day on the Wisdom Investor, so subscribe and turn on notifications so you never miss an episode. I'm Michael, this is the Wisdom Investor, and I'll see you in the next one.